The investor meeting was scheduled for Thursday at 2 in the afternoon. 3 partners from the firm, my business partner, and me. They had been talking to us for almost 6 months about a Series A round that would have valued our company at around $40 million. The morning of the meeting, the lead partner called me directly. He asked if I had a few minutes before the meeting to talk through some questions their finance team had flagged during diligence. He said it was nothing major. He just wanted to make sure we were aligned before everyone got in the room. The questions were not nothing major. Their finance team had pulled our bank statements as part of the standard diligence process. They had compared the deposits in our operating account against the revenue figures we had reported in our monthly investor updates over the previous 2 years. The numbers didn't match. Not by a little, by a lot. In some months, the revenue we had reported was almost double what had actually hit our bank account. The lead partner asked if there was an explanation. He was being polite about it, but I could hear in his voice that he was giving me one chance to have a good answer. I didn't have one. I had no idea what he was talking about. I had not written those investor updates. My business partner had. He had handled the financials and the investor communications from the beginning because that was his background and because I had been focused on building the product. I told the lead partner I needed to look into it and would call him back within the hour. I hung up the phone, walked into my partner's office, and asked him to explain to me, very carefully, what he had been sending to our investors for the last 2 years. He couldn't. His name was Chris. We had started the company together 4 years earlier. We had met in graduate school, worked together briefly at a different startup, and decided to go out on our own when we saw a gap in the market we both thought we could fill. Our company built logistics software for mid-sized e-commerce businesses. I was the technical co-founder. He was the business co-founder. He handled sales, finance, fundraising, and investor relations. I handled the product, the engineering team, and operations. The split had worked well for the first 2 years. We had raised a small seed round from a handful of angel investors. We had hit our early milestones. We had grown the team to about 20 people. By the end of year 2, we were generating real revenue and starting to talk to institutional investors about a larger round. That was when I started noticing small things, not anything I could put my finger on at the time. Just a sense that the financial picture Chris was describing in our partner check-ins didn't quite match what I was seeing on the engineering side. He was telling me we were ahead of plan. He was telling our investors we were ahead of plan. But our hiring was conservative. Our infrastructure spending was being scrutinized, and Chris was the one approving expense requests with a level of caution that didn't seem consistent with a company that was crushing its targets. I had asked him about it once. He had told me that we needed to be disciplined with cash because the fundraising environment was uncertain, and that being conservative now would put us in a stronger position when we did go out for the next round. I had accepted the answer. I had no reason not to. When the Series A discussions started, Chris had taken the lead on preparing the materials. He had built the financial model. He had written the investor updates. He had managed the diligence process. I had reviewed the technical sections and signed off on the product roadmap. I had assumed the financials were accurate because I had no reason to assume otherwise. The morning of the Thursday meeting, sitting in his office, I realized I had been wrong about that assumption for a very long time. Chris asked me to give him until the end of the day to put together a clean explanation. I told him no. I told him I needed to see the actual numbers, the actual bank records, and the actual investor updates side by side, and I needed to see them now. He hesitated. Then he opened his laptop and started pulling up files. What I saw over the next 3 hours was worse than what the lead partner had described on the phone. The pattern had started about 18 months earlier, around the time we had begun talking to larger investors. Chris had been overstating revenue in our monthly updates, not by inventing customers. The customer counts in the reports were accurate, but by inflating the revenue per customer, by reporting bookings as recognized revenue, and by counting pipeline deals as closed deals. The cumulative gap between reported revenue and actual revenue was around $4 million over the 18-month period. The reports had been sent to our existing investors quarterly, and they had been used as the foundation of every conversation we had been having with new investors for the last 6 months. I asked him why. He didn't have a clean answer. He talked about pressure. He talked about wanting the company to look strong while we were fundraising. He talked about telling himself that the real numbers would catch up to the reported numbers within a quarter or two, and that no one would ever know the difference. The real numbers had not caught up. The gap had grown larger every quarter because the reported numbers had grown faster than the business actually had. I asked him whether the existing investors knew. He said they did not. The quarterly updates we sent them included the same inflated figures we'd been showing to the new investors. That changed things. Misrepresenting financials to a prospective investor during diligence is one thing, bad, but potentially correctable. Misrepresenting financials to existing investors who had already put money into the company in formal quarterly reports was something else entirely. That was securities fraud. I called the lead partner back. I told him we needed to postpone the meeting. I told him I had identified discrepancies in the materials we had submitted and that I needed time to investigate fully before we continued any conversations with his firm. He thanked me for the call and said he would expect to hear from me when I had a complete picture. His tone made it clear that the deal was over. The only question was how much damage was going to be left behind. I called our company's outside counsel that afternoon. He listened to what I had found, asked a few questions, and then told me what I needed to do. I needed to get a forensic accounting firm in immediately to audit the actual financials. I needed to notify the board, and I needed to disclose the discrepancies to our existing investors as soon as the accounting firm had a defensible set of corrected numbers. The audit took about 6 weeks. The corrected numbers were worse than I had feared. The company was real, the customers were real, and the product was real. But the revenue was about 60% of what we had been reporting. We were not a company on the verge of a $40 million valuation. We were a company that was burning cash at a rate that gave us about 9 months of runway before we ran out of money. I notified the board, I notified the existing investors. The conversations were brutal. 2 of the angel investors threatened to sue. One of them eventually did. The lead investor from our seed round, who held a board seat, demanded Chris's immediate removal as a condition of any further support. Chris resigned the same week. The terms of his departure were negotiated by lawyers and included a release of his equity in exchange for the company not pursuing civil claims against him. He left the city within a month. I do not know where he went after that. The lawsuit from the angel investor settled out of court about a year later for an amount that the company could afford, but that significantly reduced our runway. I personally wrote letters of explanation to every other investor and offered to refund their investment at cost if they wanted to exit. 2 of them took me up on the offer. The rest stayed. I rebuilt the financial reporting from the ground up. I hired a real CFO, not a co-founder doing finance on the side, but an experienced finance executive with a background in audited public reporting. Every monthly report after that was tied directly to the bank statements and the accounting system. Every investor update went through her review before it went out. We did eventually raise our Series A, not at 40 million, at 12, from a different firm, with full disclosure of everything that had happened. The new investors did their diligence with eyes wide open and decided the business was worth backing, despite the history. The company is still running. We are larger now than we were when Chris left, and the revenue numbers we report are real numbers. The gap between what we say and what is true is 0, and I check it personally every month. I trusted the wrong person with the wrong responsibility. I did not verify what I should have verified. I assumed that a co-founder I had known for years would not be capable of doing what he did. I was wrong about that, and the cost of being wrong was almost everything I had built. If this story hit you, subscribe. Every case on this channel starts with trust and ends with the truth.